Let's explore the intricacies of the statement of cash flow and its preparation using the direct method. In this video, we'll delve into the importance of understanding cash flow, break down the differences between cash and profit, and unravel the mysteries of the cash flow statement itself. By the end, you'll be equipped with the knowledge to navigate the world of financial statements with confidence. So let's dive in and discover the power of the cash flow statement. Unlock the secret to financial success with Counting Coins, where numbers come alive and your accounting game thrives. Are you eager to delve into the realm of cash flow and the statement of cash flows? If so, you're in for a treat. We'll embark on an enlightening journey where we'll unravel the intricacies of the accrual basis of accounting and its relationship with cash flow. You see, many viewers like you have a keen interest in understanding the cash flow statement and the direct and indirect methods. That's why I've dedicated this episode to shedding light on this important topic. Now, I know the statement of cash flows can seem a bit intimidating at first, but fear not, cash is king. And understanding cash flow is absolutely crucial, especially for small businesses. So let's embark on this journey together and demystify the cash flow statement. First things first, let's clear up any confusion between cash and profit. They are not the same thing. Profit represents the bottom line on an income statement and pertains to a specific period of time. On the other hand, cash refers to the actual amount of money available at a particular point in time, like the balance in your bank account. Cash and cash equivalents encompass not only physical cash but also other liquid assets that can be easily converted to cash. However, it's important to note that cash flows are different from the actual cash itself. Cash flows track the movement of cash in and out of a business over a specific period. Here's where things get interesting. When we use the accrual basis of accounting, which is the standard practice, revenue is recognized when it's earned, not when cash is received. Similarly, expenses are recorded when they are incurred, not when cash is paid out. This means that revenue doesn't always equal cash inflow, and expenses don't necessarily equal cash outflow. Now, this distinction is crucial because poor cash flow management is one of the major reasons why small businesses fail. Imagine a business that appears profitable on paper but doesn't have enough cash on hand to pay its employees, creditors, or even the interest on its loans. It's a recipe for disaster. And that's precisely why the expression cash is king holds so much weight, particularly in the realm of small businesses. Now let's move on to the star of the show, the cash flow statement, also known as the statement of cash flows. This statement, along with the income statement and balance sheet, forms the trio of essential financial statements. Think of the cash flow statement as your guide to understanding how and why the cash balance of a business changed over a specific period. It breaks down cash inflows and outflows into three main sections: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Starting with cash flow from operating activities, this section focuses on the cash generated from the business's core revenue-generating activities. In simpler terms, it showcases the cash received and paid out during the regular course of business. When customers pay for the products or services they've received, cash flows in. Conversely, when a business pays its suppliers, employees, or taxes, cash flows out. It's important to note that the direct and indirect methods differ in how they present the cash flow from operating activities. In today's video, I'll focus on the direct method. Now let's take a closer look at the different fictitious company, Crystal Pharmaceuticals, and examine how their cash flow statement is prepared during the direct method. In the cash flow from operating activities section, we observe the cash receipts from customers, which mainly stem from sales of pharmaceutical products and medical supplies. If Crystal Pharmaceuticals were using cash accounting, these cash receipts would directly respond to the revenue for the same period. Moving on, we have cash paid out to suppliers, employees, interest, and income taxes, which align with their respective expense categories on the income statement. If you've liked the video so far, please give it a like, subscribe, and let us know in the comments what you would like us to cover next. Now back to the video. Moving right along, we come to cash flow from investing activities. This section covers cash flows related to investments outside of the business's core operations and the purchase or sale of non-current assets. For example, When a business invests in new equipment or sells off existing assets, cash flows out or in, respectively. In the case of the Crystal Pharmaceuticals, they had cash inflows of $15,000 from selling their old laboratory equipment and cash outflows of $70,000 from purchasing new laboratory equipment. These transactions fall under investing activities because buying and selling laboratory equipment isn't the team's core business activity. Lastly, we have cash flow from financing activities. This section focuses on cash flows related to financing the business's operations. It includes changes in share capital, borrowings from banks or third parties, and other financing activities. For instance, when a company issues new shares or takes out a loan, there's a cash inflow. Conversely, when a business repays a loan or buys back shares, cash flows out. In the case of the Crystal Pharmaceuticals, they had a cash inflow of $20,000 from long-term borrowings. Now, when we subtotal these three sections, we arrive at the net increase or decrease in cash for the year. In the example of the Crystal Pharmaceuticals, there's a net increase of $35,000, which aligns with the change in their cash balance as shown in the balance sheet. The closing balance of $185,000 minus the opening balance of $150,000 indeed gives us a net increase of $35,000. Voila! The statement of cash flows prepared using the direct method is a valuable report for investors to analyze. It allows them to easily identify where cash flowed in and out of a business. By examining the cash flow statement, investors can see that the Crystal Pharmaceuticals paid out the most cash to suppliers, which was their biggest cash outflow. It's an intuitive method of presenting cash flow, which is why it's a preferred choice for many. However, many people opt for the indirect method instead. But why? Well, the truth is, the cash flow from operating activities can be quite challenging to calculate using the direct method, especially for larger companies operating under the accrual basis of accounting. It can be a costly and time-consuming process to gather all the necessary information and piece it all together. That's where the indirect method comes in as a more straightforward alternative. However, it's worth noting that while the indirect method may be easier for companies to implement, it's often harder for investors to understand. Both methods are allowed under accounting standards like GAAP and IFRS, but the direct method is generally preferred. The statement of cash flow and its preparation using the direct method hold the key to understanding the movement of cash within a business. We've learned that cash and profit are not synonymous, and the poor cash flow management can spell disaster for even profitable ventures. By dissecting the cash flow statement and its three sections, operating activities, investing activities, and financing activities, we've gained valuable insights into how cash flows in and out of a company. While the direct method offers intuitive presentation, the indirect method is often favored due to its simplicity. Nonetheless, both methods serve a vital purpose in financial reporting. Are you ready to take your financial understanding to the next level? What aspects of the statement of cash flow and the direct method intrigue you the most? Don't forget to comment below with your thoughts, questions, and accounting victories. And make sure to hit the subscribe button and turn on notifications so I'll see you in the next episode of Counting Coins. Happy accounting!